Welcome to the Volatility Box Report for August 7th, 2019. We are TOSindicators.com, home of the Volatility Box. Before we get started, we'd like to apologize. Quite a few of you emailed us asking why there have been no new YouTube videos or tutorials. We've been a little busy working away at building the daily ranges volatility box, which we'll show you in this video. But that's why the radio silence. But I think you'll see that it was hopefully worth it. Also, stay tuned. We should be releasing our next tutorial video later this week. Okay, so with that, let's dive into the Volatility Box report for today. So early in the morning, we sent out this note to all of our traders, alerting them that we were experiencing greater than usual volatility, and that they may want to sit today out. And if they do participate, the place to participate today was the Russell futures, which, if you actually look at using the volatility box, worked out fairly well. Apart from that, we used the daily volatility ranges to trade today, and that's what we'll spend a good bit of time talking about. So before we actually show you on the charts what the daily volatility box looks like, we're going to first talk about our process. And I think it's important to talk about how we got to the daily volatility box, because oftentimes I think one of our most popular questions is why our price point. I think our closest competitor, AutoChartist, is significantly cheaper than our service, and people are often wondering why. What's the difference? Like at the end of the day, they're really just volatility ranges. And today we're going to show you an actual P&L difference, just what would have happened using our models versus competitor models. But before we do that, let's address like the process that actually goes in to build each volatility box, both the hourly along with the daily. We first build these models, and these models take quite a bit of time to build. After they've been built, we observe them, and we observe them for more than 6 months. We're taking detailed notes, we're understanding what's different. The day of the week, we're understanding the hours, we're understanding how the market works, how the intermarket relationships work, and all of these observations are then getting processed into learnings, which help us improve the volatility box. We then make these improvements and we measure the results. We see, okay, were these good improvements or were they bad improvements? And that then goes in to build the next version of the volatility box, and so on and so forth. So as you can see, this process is quite a strenuous one. But what you get with that is actual humans who are observing this, data scientists who look at these models all day long, the data, and they're actually tweaking it. They're making real-time adjustments as opposed to just plugging them into something that's more generic and chugging out numbers that while they may be good, they're not excellent. They don't actually give you an edge. And so with that, let's actually look at what would have happened using our daily volatility ranges, which it's in beta mode right now, and we expect to be releasing this fairly soon, compared to the daily ranges that's available using AutoChartist data. And you can see the actual P&L differences. So on the left-hand side, we have the P&L using the volatility boxes, daily ranges, our models that we use to build both the hourly and the daily ranges. And on the right-hand side, you'll see the P&L using AutoChartist daily ranges, which, by the way, if you don't believe me, feel free to go on their website and actually measure these trades out on the levels that you will be seeing on the chart soon. And you can see that this is exactly the result that would have happened. The difference between the two models and the difference in terms of how they're calculated and the statistics that go behind it. Using the volatility box, our NPNL was a total of 3160, and using AutoChartist models, your day ended up actually being a loser because the models didn't quite capture the volatility that we experienced today, and didn't really capture last week's volatility to reflect the numbers the way they should be reflected, given the weight that we're now in a greater than usual volatility period, given the past few days in the market. And so with that, let's actually dive into the charts. We'll take a look at each of these, the S&P futures, see how the volatility box did, the NASDAQ futures, where there was a killing trade and it went perfectly to the target line that we often call in our hourly volatility box. The Dow futures, once again, monster, and the Russell futures, which the trade came towards the market close. A small win, but a win nonetheless. Okay, with that, let's dive into the charts. Let's start with the S&P futures. So on the chart, we've tried to simplify it here. We've only put 3 lines instead of having the clouds, and so we'll talk about what each one of these 3 lines represents. This first line is the red line, which represents AutoChartist maximum daily price movement range for a Wednesday. And so what we've done is we've taken the low and we've added the maximum number of points that AutoChartist thinks that the price should move. And so the entry line is actually quite a bit below the red lines in each of these charts. And this is the maximum price movement range that AutoChartist thinks is true. The blue line is our entry line using the volatility box, and this is where we would enter the trade. This green line represents our stop, and so anything outside of this means that this trade has stopped out. And so ideally, we'd like to see that the trade holds into the blue line, the blue cyan line, but doesn't breach the green line and essentially comes back. And our first target is always what we risk. And then we also have our target line that we define, which is useful on the NQ, which you'll see plotted. And so looking at that, if we study the S&P chart for today, what you'll see is early in the morning, right around 8 o'clock, that's where we got our entry using the Volatility Box daily price movement range models. We stayed perfectly within, and we went for a puke thereafter. And had you used a competitor's models, you see that you would have been stopped out right here, unless you somehow happen to magically have the crystal ball and know that your stop should be somewhere out here. But your risk is also defined in a far inferior manner, since your entry would have been somewhere. Would have been somewhere closer to here, with the stop outside of here. So let's take a look at the Nasdaq now. So same concept. You see the three lines. This time you'll also see one additional line, and this line is our target line, which is also predefined in the indicator, and you have a set level that you can set as your target line. And so once again, looking at this, the levels looking up, the entry using AutoChartist would have been somewhere way down here with your stop here. You would have been stopped out using that model. However, our volatility box gave us an entry right here, which is the true edge. Our stop was right outside of here. And we went for our first target was our minimum risk, which is up to right here. And then our second target is the target line, which we hit perfectly before we started to bounce back up. And so once again, you see that the Nasdaq trade survived versus the volatility box. The volatility box gave you a true edge and gave you actually you faced very little heat here on the puke down, and that was a beautiful risk to reward trade that ended up paying off in spades. Next, let's take a look at the Dow futures. So once again, same concept, three lines. And so the entry using AutoChartist would have been somewhere down here. With your stop, once again, stopped out. Using the volatility box, our entry was at the cyan line. You had two opportunities. Our stop was right outside of our clouds, which is outside of this green line. And once again, you got this puke. You hit your minimum first target. You did not go to T2, but you did make money on this trade, which is a hell of a lot better than getting stopped out. And finally, let's take a look at the Russell futures. So same concept, once again, our three lines. Your entry with AutoChartist would have been stopped out, unless you once again happen to have the crystal ball where you know exactly where your stop needs to be. The volatility box, on the other hand, our models, your entry came beautifully into the entry line. Our stop was right outside of 1508.5. This was towards the end of the day in the market. And so you could have taken this trade. It was a very low risk trade, and you got exactly your puke down to hit our T1, which was a beautiful trade to fade the rally into the end of the close. We're really excited about the Volatility Box daily version. As you can see, we've spent quite a bit of time perfecting this model, and it's paid off, at least so far. The model seems to be outperforming at least the models that are currently out there by competitors in every single ticker so far. And we hope to see this future, at least this performance going forward. So as you can see, once again, the Volatility Box models today outperformed our competitors. And that's really what you get with the Volatility Box. You get models that adapt to today's market condition and let you trade at the edge with an edge. If you'd like to learn more, visit our website at tosindicators.com/volatilitybox. Thank you and happy trading.